In my last broadcast, I spoke about the do and how VMG Investments became a minority partner. If you got the time to listen and look at that presentation, I did indicate that I would be doing a three-part series, and it would be predicated on funding. So today, I'm going to be doing it. And it is about the five things that a female founder, woman owned business owner, or even a founder who's not female, these are the five things that you should be aware of and that you should have in place before you go for funding. So here's how I'm going to do it. I'm going to do it in three parts. So today you'll get part 1 and 2, and then you're going to get part 3 and 4, and I'm going to close off with part 5. So once you agree with that, and I like to do things in bite-sized portions so that it'll be easy for you to digest, let's get started. So before you ask a bank, an investor, a credit union, a grant provider, or a strategic partner to put money into your business, I need you to pause. Not because you're not capable, not because your vision isn't valuable, and certainly not because you need one more person telling you to wait your turn. I need you to pause because funding doesn't only give your business more money. Funding places your business under closer examination. And if the structure beneath the business is weak, unclear, or undocumented, that money may not solve the problem. In fact, it may expose it. I'm Rhonda Glynn, the Fundability Strategist. I help women founders, Caribbean entrepreneurs, and growing SMEs strengthen the structure, evidence, financial visibility, and credibility beneath their businesses. Because here's the thing, your business should not only look promising, it should be able to prove that it is ready. So before you submit that application, schedule that investor conversation or start asking, who can fund your idea? Check these 5 things. And stay with me until the end, because I'm going to give you one question that can help you decide whether you're genuinely ready to ask for money or whether your next step should be strengthening the business first. Number 1, can you clearly explain what the money is for? Because business growth is not a clear use of funds. Marketing is also not enough. Buying stock is also not enough. Expanding the business is still too vague. Before you ask for funding, you must be able to explain exactly what the money will do. How much do you need? What will you spend it on? When will you spend it? What result should that spending produce? And how will the business repay the money or create a return from it? For example, don't simply say, I need $100,000 to grow. Instead, say, I need $100,000 to purchase equipment that will increase my monthly production capacity from 500 units to 900 units. Based on current demand and confirmed orders, the additional capacity is expected to increase monthly revenue by approximately $35,000. Now, when you say that, then we are having a funding conversation because the request is connected to a business outcome. That's because a lender wants to understand repayment. An investor wants to understand return and growth potential. A grant provider wants to understand impact. A strategic partner wants to understand value. And all of them need to see that you understand the relationship between the money you are requesting and the result it is expected to create. So before you ask for funding, complete this sentence. I need this amount of money to do this specific thing, which should produce this measurable result. If you can't complete that sentence, clearly you may not be ready to apply yet. You may simply be feeling financial pressure. And no doubt about it, pressure is real. But pressure is not a funding strategy. Number 2, are your financial records clear and current? This is where many capable founders get uncomfortable. That's because they know the business. They know the customers. They know how much effort it takes to run the business. But they cannot clearly show what the business earned, what it spent, what it owes, what customers owe it, or what remains after the bills have been paid. And here is the hard truth. A funder cannot finance what he or she cannot verify. So you may know that the business is doing well, but fundability isn't only what you know, it is what business can prove. So here's my question for you. Can you produce current financial statements? Do you have a clean bank record? Are your personal and business expenses separated? Do you know your average monthly revenue? Do you know your fixed and variable expenses? Do you know whether the business is actually profitable? Do you understand your cash flow pattern? And are your tax, registration, and compliance records in order? Because revenue alone does not tell the whole story. A business can generate significant sales and still struggle to pay its obligations. A business can appear successful and still have weak margins. A founder can be booked every week and still not know where the money is going. And that is why I say revenue is not resilience. Revenue tells us money entered the business. Resilience tells us whether the business can manage that money, survive disruption, meet its obligations, and continue operating. So before you ask for funding, your numbers should not be hidden in your head, scattered across WhatsApp messages, mixed into your personal bank account, or sitting in a shoebox waiting for the accountant. That's because your accountant can help you prepare the information. But you, the founder, must understand what the numbers are saying. Because when a founder asks a question, confidence is not pretending to know. Confidence is being able to explain the business clearly and succinctly using numbers. In part 3, we are going to talk about the pricing and the trauma behind it. In the meantime, subscribe to my channel where we talk all about funding, financing, and how to create a business that funders are able to successfully into.